Keith Kohl claims Warren Buffett is about to make his biggest investment ever in a certain sector, but won't reveal the specific stocks unless you buy his newsletter. However, he left enough clues to figure out each stock, and I reveal them all here for free. Just drop a like and subscribe if you appreciate getting these stocks for free. There are a lot of stocks to cover, so we're just going to jump into things. The idea behind the teaser is that Warren Buffett plans to move his vast cash reserves into Canadian energy stocks. The first of the 4 stocks Keith actually gives away for free is Cenovus Energy. Keith claims Cenovus is not only the largest producer of Canadian oil sands, but is also well positioned to capitalize on the Trans Mountain Pipeline expansion. He adds, for an investor like Warren Buffett, who deeply values fundamental analysis, Cenovus is an ideal choice. Keith also highlights that this stock stands out due to its strong combination of value and dividends. Cenovus Energy is a Canadian integrated oil and natural gas company headquartered in Calgary, Alberta. It specializes in producing oil sands in northern Alberta, conventional oil and natural gas in Western Canada, and refining operations in the United States. The company is known for its focus on sustainable energy practices, including reducing greenhouse gas emissions and improving resource efficiency. Cenovus operates refineries through joint ventures and has a significant presence in both upstream and downstream energy markets. I personally think Cenovus Energy is a buy, and here's why. First is strategic growth. Cenovus has announced a capital investment plan ranging between $4.6 billion and $5 billion for 2025, aiming to boost upstream production to 805,000 to 845,000 barrels of oil equivalent per day. Second is shareholder-friendly. The company is dedicated to returning 100% of excess free funds flow to shareholders, demonstrating a strong commitment to investor returns. Third is analyst confidence. Jefferies analyst Lloyd Byrne recently maintained a buy rating on Cenovus Energy, setting a price target of $32, indicating confidence in the company's prospects. Fourth is operational efficiency. Cenovus plans to achieve downstream crude unit utilization rates between 90% and 95% in 2025, reflecting a focus on operational efficiency and reliability. Fifth is strong financial performance. In the second quarter, Cenovus reported a net income of $1 billion, up from $866 million a year earlier, driven by higher throughput volumes and increased production. These factors highlight Cenovus Energy's strategic initiatives, financial health, and commitment to delivering value to shareholders, making it a noteworthy consideration for investors. I'm going to reveal the rest of the stocks in about 20 seconds, but before I do that, I want to remind you to click the link in the description to check out Alpha Picks. I reviewed over 100 stock picking services, and Alpha Picks performs the best and actually beats the market easily. If you click the link in the description, you get $50 off Alpha Picks. So go ahead and click that link and take advantage of this amazing deal. Here's how Keith describes the second stock. This company is a strong opportunity at its current price. Operating across Canada, the United States, and internationally, it's already benefiting big time from the Trans Mountain Pipeline expansion, and is on track to becoming Canada's leading energy provider. One of their crude oil tankers was among the first to load oil from the expanded pipeline, exporting approximately 550,000 barrels of crude oil to China. This strategic move positions the company to compete directly with U.S. oil producers by targeting overseas markets. Additionally, the company is capitalizing on the pipeline expansion by leasing and operating its own fleet of oil tankers to carry crude to Pacific markets. By managing the tankers themselves, they save on shipping costs and capture full value from their operations. As the company's executive vice president put it, "We're well positioned to deliver volumes to our customers, eliminate the middleman, and capture the full value." The company's recent performance underscores its strength, including all-time high oil sands production of 785,000 barrels per day. With offices in Calgary, Houston, and London, this company has been strengthening relationships with customers on the West Coast and in Asia to fully capitalize on the Trans Mountain project. It's easy to see why Buffett would be interested in buying shares of this stock. The stock being pitched here is Suncor, and the ticker is SU. The stock is currently trading at around $35. I personally think Suncor is more of a hold or borderline buy, and here's why. First is analysts signal moderate buy. Suncor Energy has received a consensus rating of moderate buy from analysts, with an average price target of $56.40, indicating potential upside. Second is the dividend. With a quarterly dividend recently increased to 41 cents per share, Suncor offers an attractive annualized yield of 4.14%, appealing to income-focused investors. Third is operational turnaround. Under new leadership, Suncor has enhanced its safety record and operational performance, contributing to improved financial results and increased investor confidence. Fourth is Elliott Management doubles down. Elliott Investment Management has nearly doubled its stake in Suncor to $3 billion, signaling strong confidence in the company's ongoing improvements and future prospects. Fifth is market volatility ahead. Given the cyclical nature of the oil industry and potential market fluctuations, maintaining a hold position on Suncor allows investors to benefit from dividends while awaiting more favorable market conditions. Here's what Keith says about the third stock. Just one day after the Trans Mountain Pipeline opened, this company announced plans to boost output at its oil sands mine by 195,000 barrels per day. That's a staggering 76% increase from its current production of approximately 255,000 barrels per day. And they're not stopping there. With major upgrades at its oil sands mining facilities and a new facility in Alberta scheduled for completion by the end of this year, they're set to add another 5,600 barrels per day to their production capacity. This company's consistent track record of strong financial performance has made it a favorite among energy investors and analysts. Their commitment to returning 100% of free cash flow to shareholders further enhances its investment appeal. As one prominent energy analyst recently noted, this stock remains our favorite producer. The stock being pitched here is Canadian Natural Resources, and the ticker is CNQ. This stock is currently trading at around $30. This is another hold or borderline buy for me, and here's why. First is consistent dividend growth. Canadian Natural Resources has an impressive track record of increasing dividends for 25 consecutive years, boasting a compound annual growth rate of 21%. This consistency makes it a reliable choice for income-focused investors. Second is recent acquisitions. The company recently completed a $6.5 billion acquisition of Chevron's stakes in the Athabasca Oil Sands Project and the Duvernay Shale. This strategic move is expected to enhance production capacity and strengthen long-term growth prospects. Third is strong financial position amid market volatility. Despite fluctuations in commodity prices, Canadian Natural Resources maintains a robust financial position, with a levered free cash flow margin of 23.3%. This financial strength enables the company to navigate market uncertainties effectively. Fourth is analyst consensus is moderate buy with upside potential. The stock has received a consensus rating of moderate buy from 15 research firms, with an average 12-month price target of $71.94, indicating a potential upside of approximately 69% from the current price. Fifth is recent pullback presents opportunities. While the stock has experienced a recent pullback, closing at $43.95, which is $13.66 short of its 52-week high of $56.50. This decline may present a buying opportunity for value investors looking to capitalize on potential rebounds. Here's what Keith says about the last stock. This company uses a fully driverless fleet of heavy trucks for oil production. This company is one of Canada's largest oil producers and is an outstanding addition to any oil investor's portfolio. What truly sets it apart is its pioneering use of a fully autonomous fleet of heavy haul trucks for oil production. These driverless trucks transport extracted oil sands from the pit to the processing facilities. By eliminating the need for human drivers, the company gains significant advantages in safety and efficiency, positioning itself as a leader in sustainable oil sands production. And the results are impressive. The company recently reported its highest production levels in over 30 years, setting a new benchmark. At their flagship oil sands mine, full-year production hit a record 270,000 barrels per day. With the completion of the Trans Mountain Pipeline expansion, their performance is only set to improve further with access to even more lucrative markets. Financially, this company is incredibly robust. Shareholders are already benefiting from the company's strong performance, with a dividend payment increase to 60 cents per share, up from 50 cents per share. With its impressive production achievements, innovative operational strategies, and solid financial footing, this company represents a compelling investment opportunity. This stock is Imperial Oil Limited and the ticker is IMO. This stock is currently trading at around $63. I personally think this stock is a buy, and here's why. First is record-breaking production levels. Imperial Oil has achieved its highest second quarter production in over 30 years, reaching 404,000 barrels of oil equivalent per day. Second is strategic capital investment for future growth. The company plans to invest between $1.9 to $2.1 billion in 2025, focusing on enhancing bitumen recovery and advancing projects like the Strathcona Renewable Diesel Facility set to commence operations next year. Third is consistent dividend payouts. With a dividend payout ratio at a sustainable 25.16%, Imperial Oil offers a dividend yield of 2.32%, providing investors with reliable income. Fourth is strong financial health. Imperial Oil maintains a robust balance sheet with a current ratio of 1.44 and a 29-year streak of consecutive dividend increases, reflecting its commitment to shareholder returns. Fifth is technological innovation and low-carbon initiatives. The company is at the forefront of technological advancements in the oil sands industry, particularly in solvent extraction technology, positioning it well in an environmentally conscious market. And if you really want to make money with the stock market, make sure to click the link in the description to check out Alpha Picks from Seeking Alpha. I've reviewed hundreds of stock picking services, and this one performs the best. Since its inception 2 years ago, it's absolutely been crushing the market and has tripled the returns of the market in that time period. And if you click the link in the description, you get $50 off this service. So make sure to click that link now and start investing the smart way.